If you've started learning about investing, you've probably come across four common terms: ETFs, mutual funds, REITs, and bonds. At first, they can sound confusing, but the truth is, these are simply different ways to invest your money. Some focus on stocks, some focus on real estate, some focus on lending money safely. In this video, I'll explain each one in the simplest way possible, with clear examples so you can easily understand how they work. Let's start with something most beginners hear about first: ETFs. An ETF, or exchange traded fund, is basically a collection of investments bundled together into one product. Instead of buying one single stock, an ETF lets you buy many investments at once. Think of it like buying a fruit basket instead of one apple. Inside that basket could be dozens or even hundreds of companies. One famous example is the Vanguard S&P 500 ETF. This ETF tracks the S&P 500, which contains 500 of the largest companies in the United States. When you buy this ETF, you're indirectly investing in companies like Apple, Microsoft, Amazon, Nvidia, Google, all with one purchase. Why investors like ETFs? Very diversified, usually low fees. Easy to buy and sell like a stock. That's why ETFs are one of the most popular investments for beginners today. Mutual funds are actually very similar to ETFs, but there's one big difference. Mutual funds are actively managed by professional investors. This means a team of experts decides which stocks to buy, when to sell them, how to adjust the portfolio. Instead of following an index automatically, they try to beat the market. A famous example is the Fidelity Contra Fund. This fund invests in large companies that managers believe will grow faster than the market. So when you invest in a mutual fund, you're basically saying, I want professional investors to manage my money. However, this usually comes with higher fees because you're paying for the expertise of the fund managers. Key features of mutual funds: managed by professionals, diversified investments, usually higher management fees, bought and sold once per day. Many retirement accounts still use mutual funds for long-term investing. Now let's move to something completely different: real estate investing. A REIT, or real estate investment trust, is a company that owns and manages properties. These could include apartment buildings, shopping malls, hospitals, data centers, hotels. When you buy shares of a REIT, you're basically owning a small part of many properties. The company collects rent from tenants, and most of that income is paid to investors as dividends. One well-known REIT is Prologis. Prologis owns massive logistics warehouses used by companies like Amazon to store and ship products. As those companies pay rent, investors receive a share of the profits. Why investors like REITs? Exposure to real estate. Often high dividend payments can be bought easily on the stock market. It's basically real estate investing without buying a building yourself. Bonds work differently from the other investments. When you buy a bond, you're not buying ownership. Instead, you're lending money. You might lend money to a government, a corporation, a city, or municipality. In return, they promise to pay you interest over time. For example, imagine you buy a $1,000 bond that pays 4% interest. Every year you would receive $40 in interest payments. At the end of the bond term, the borrower returns your original $1,000. A famous example is U.S. Treasury bonds issued by the U.S. government. Because governments are unlikely to default, treasury bonds are considered one of the safest investments. Why investors use bonds? Stable income, lower risk, helps balance a portfolio. However, the trade-off is that returns are usually lower than stocks. Here's a quick way to remember the difference. ETFs, a basket of investments that tracks a market index. Mutual funds, similar to ETFs but managed by professional investors. REITs, companies that invest in real estate and pay rent income to investors. Bonds, loans you give to governments or companies that pay interest. Each one plays a different role in investing. The truth is, most long-term investors don't choose just one. They combine ETFs, bonds, and sometimes REITs to build a balanced portfolio that grows over time while managing risk. If you found this explanation helpful, make sure to like the video and subscribe for more simple investing breakdowns. And I'll see you in the next one.